Hello, welcome to Capital Sensei. Today we're going to break down one of the most straightforward and powerful investment philosophies out there, the strategy of Terry Smith, often called the English Warren Buffett. We'll dive into his simple three-step mantra: buy good companies, don't overpay, and then do nothing. We'll explore exactly what he means by a good company, how to tell if you're overpaying, and why the hardest part is often having the discipline to just sit still. Whenever we can, we answer questions in the comments. The world of investing can feel complex, and hearing from others on the same journey can be incredibly helpful. So please, share your thoughts, your questions, or even your own investment experiences below. Let's build a community where we can all learn from each other. So, who is this Terry Smith character? And why should we listen to him? Think of him as the ultimate no-nonsense fund manager. He built a massive fund, Fundsmith, with a track record that speaks for itself. And he did it by following a set of principles that are, on the surface, incredibly simple. He's famous for his annual letters to shareholders where he pulls no punches, calling out a lot of the foolishness and complexity that pervades the financial industry. His core philosophy can be boiled down to a single, powerful sentence: buy good companies, don't overpay, do nothing. Now that sounds almost insultingly easy, doesn't it? But like many profound ideas, the genius is hidden in the details of each part. It's not just a catchphrase, it's a rigorous discipline. Let's start by unpacking the first and most important step: buy good companies. What on earth does he mean by a good company? This isn't about whether they have a nice logo or a friendly chief executive officer. For Smith, a good company is a money-making machine. Specifically, it's a business that consistently generates a high return on the capital it employs. This is a critical concept, so let's break it down with an analogy. Imagine you want to open a pizzeria. You spend $100,000 on a fancy wood-fired oven, marble countertops, and a sophisticated ordering system. That's your capital employed. In your first year, after paying for all your ingredients, staff, and rent, you have a profit of $5,000. Your return on capital is 5%. Not bad, but not amazing. Now your friend opens a pizzeria down the street. She buys a simple, second-hand oven and keeps her setup basic, spending only $20,000 in total capital. But she's in a fantastic location, and her pizza is a hit. In her first year, she also makes a profit of $5,000. Her return on capital is a whopping 25%. For every dollar she invested in her business, she's getting 25 cents back in profit each year. Terry Smith wants to invest in your friend's pizzeria, not yours. He is obsessed with finding businesses that can take a dollar of capital and turn it into a high and sustainable stream of cash profits, year after year. This metric, the return on capital employed, or ROCE, is his North Star. It's the first and most important filter for identifying a truly great business. Why is this so important? Because a company with a high return on capital is a natural compounding machine. You've probably heard about the magic of compound interest, where your money earns interest, and then that interest starts earning its own interest. It's like a snowball rolling downhill, getting bigger and bigger on its own. A high return on capital business does the same thing, but with its own profits. Let's go back to the pizzerias. Your friend, with her 25% return, can take her $5,000 profit and reinvest it to open another small, efficient pizzeria. That new location will then start generating its own high returns. Your business, with its 5% return, will take much longer to save up enough profit to expand. The high-return business can grow faster and more efficiently, funding its own expansion from its own profits. This is the engine of long-term wealth creation. Smith argues that over the very long run, the return you get on your investment in a stock will be very close to the return on capital that the underlying business itself generates. So, if you want a high return on your money, you must own businesses that generate a high return on their money. It's that fundamental. So beyond just a high return on capital, what other traits do these good companies share? Smith looks for businesses with significant intangible assets. These aren't physical things like factories or machinery. They are powerful, invisible moats that protect the business from competition. The most common one is a strong brand. Think about it. You could make a brown, sugary, fizzy drink that tastes identical to Coca-Cola. You could even sell it for half the price. But you won't put Coca-Cola out of business. Why? Because the Coca-Cola brand is lodged in the minds of billions of people. That brand is an intangible asset worth hundreds of billions of dollars, and it allows them to charge a premium price and maintain their market share. Other examples include patents for pharmaceutical companies, like those that protect a blockbuster drug for a decade or more. Or network effects, like with Microsoft. The more people who use Windows in Office, the more valuable it becomes for everyone else to use them too, creating a nearly unbreakable hold on the market. These intangible assets are what allow a company to sustain that high return on capital over many years. Another key trait is recurring revenue. Smith loves businesses where customers make small, repeated purchases of essential or desired items. Think about companies like L'Oreal, which sells cosmetics, or Colgate-Palmolive, which sells toothpaste. You don't just buy toothpaste once, you buy it over and over again for your entire life without much thought. This creates a wonderfully predictable and reliable stream of revenue. It's the opposite of a company that sells something huge and expensive, like a cruise ship or a power plant, where one lost sale can devastate their entire year's results. Smith prefers the steady, predictable cash flow from millions of people buying lipstick, pet food, or software subscriptions every single month. This leads directly to another crucial feature: pricing power. A truly great business can raise its prices, at least in line with inflation, without losing its customers. Apple is a classic example. Every year, the new iPhone is a bit more expensive, and yet people still line up to buy it. Their brand loyalty and the quality of their product ecosystem give them immense pricing power. A company without pricing power is at the mercy of its costs. If the price of flour goes up, a generic bakery might have to absorb that cost and see its profits shrink, because if they raise the price of their bread, customers will just go to the bakery next door. A company with pricing power, like a premium coffee brand, can pass that cost increase on to you, the consumer, protecting its own profitability. Finally, Smith insists on a strong balance sheet, which is a fancy way of saying he avoids companies with a lot of debt. He wants businesses that are so profitable and cash generative that they don't need to borrow money to fund their operations or growth. They are self-funding. Think of it on a personal level. A person who lives within their means and has a huge pile of savings is financially robust. They can weather a job loss or an unexpected expense. A person who is maxed out on credit cards and personal loans is fragile. The slightest problem, like a car repair, can send them into a financial spiral. It's the same for companies. Low debt means resilience and strength. Now let's pause for a second, because that was a lot of information. The key takeaway for this first step is, buy good companies, is that you are looking for a very specific type of business, one that generates high returns on its own capital, is protected by invisible moats like brands or patents, has reliable, recurring revenues, and isn't loaded up with debt. These are the thoroughbreds of the business world. This brings us to the second rule of the mantra: don't overpay. This is where the art of valuation comes in. Just because a company is fantastic doesn't mean you should buy its stock at any price. Buying a Ferrari is great, but not if you have to pay $10 million for it. You can turn a wonderful company into a terrible investment by paying too much. So how does Smith determine a fair price? He's not trying to find statistical cheapness, like a low price-to-earnings ratio. He believes great companies deserve to trade at a premium price compared to mediocre ones. The key is to figure out if that premium is reasonable or if it has entered the realm of absurdity. His preferred metric here is something called free cash flow yield. Okay, I know, another piece of jargon, but stick with me. It's actually a very intuitive concept. Imagine a company's profit is like your salary, but your salary isn't what you can actually spend, right? You have to pay for taxes, your mortgage, and other essentials first. What's left over is your disposable income. Free cash flow is the business equivalent of disposable income. It's the actual hard cash the company has left over at the end of the year, after it has paid for all its operating expenses and made the necessary investments back into the business to keep it running. This is the cash that could, in theory, be returned to the owners of the business, the shareholders. It's the real reward. The free cash flow yield simply compares this leftover cash to the total price of the company, its market capitalization. For example, if a company is valued at $1 billion and it generates $100 million in free cash flow, its free cash flow yield is 10%. It's like you're buying a machine for $1 billion that spits out $100 million in cash for you each year. Smith uses this yield as a reality check. He compares it to the yield on much safer investments, like long-term government bonds. If a government bond is paying, say, 4% interest with almost no risk, a company's stock needs to offer a significantly higher free cash flow yield to compensate you for the extra risk you're taking by investing in a business. If the yield on a great company's stock is attractive relative to bond yields, say 6 or 7%, then it's probably trading at a reasonable price. If that yield has been bid down to 2 or 3% because the stock price has gone through the roof, it's likely overvalued, and he'll wait for a better opportunity. He is a quality investor, not a growth at any price investor. He's willing to pay a fair price for a great business, but he's not willing to pay a silly price. This discipline is what separates a successful investor from someone who just gets caught up in bubbles. It's easy to fall in love with a great company and its story. It's much harder to have the discipline to walk away if the price tag is just too high. It's like seeing the perfect house, but knowing it's 20% over your budget. The emotional decision is to stretch and buy it. The rational decision is to wait. This leads us to the third and, for many people, the most difficult rule: do nothing. Once you've done the hard work of identifying a portfolio of truly outstanding companies and buying them at reasonable prices, the best course of action is to sit on your hands. This sounds counterintuitive. In most areas of life, effort and activity lead to better results. But in investing, the opposite is often true. Smith is a huge proponent of the idea that your greatest enemy as an investor is often yourself, and the constant temptation to tinker, to trade, to react to the daily noise of the market. Think of it like planting an orchard. You spend a lot of time and effort finding the best location, preparing the soil, and selecting the highest quality saplings. Once they are planted, your job is to largely let them be. You don't dig them up every day to see if the roots are growing. You trust the process. You know that over years and decades, they will grow into strong, fruit-bearing trees. Constant trading is the equivalent of digging up your saplings. Every time you sell a stock and buy another, you incur costs. There are brokerage fees. More importantly, there are taxes. If you sell a stock that has gone up in value, you have to pay capital gains tax, which immediately reduces the amount of money you have left to compound for the future. Smith famously quipped that the two biggest enemies of the long-term equity investor are fund managers and the government. Fund managers through their fees and excessive trading, and the government through taxes. His do-nothing approach is designed to minimize the damage from both of these forces. By holding on to his great companies for years, even decades, he lets them compound their value without being constantly skimmed by fees and taxes. But the biggest benefit of doing nothing is psychological. The stock market is a volatile place. There will be recessions, panics, and crashes. The prices of even the very best companies can fall by 30, 40, or even 50% during a market downturn. The natural human reaction is to panic and sell, to do something to stop the pain. The do-nothing philosophy is an antidote to this destructive impulse. If you have done your homework and you are confident that you own a collection of robust, profitable, world-class businesses, then a market crash is not a reason to sell. In fact, it's just noise. The underlying business of making toothpaste or selling software is likely still doing just fine. The drop in the share price is an emotional reaction from the market, not a fundamental change in the business's quality. Holding on through these periods is brutally difficult, but it's where the real long-term returns are made. By simply staying invested, you allow your wonderful companies the time they need to recover and continue their relentless march of compounding. Terry Smith has said that the ideal holding period for a stock is forever. Of course, things can change, and a company can lose its way, but the starting mindset is one of extreme long-term partnership. So if we know what Smith looks for, it's also useful to know what he actively avoids. He is very clear about the types of businesses he will not touch. First on the list are cyclical companies. These are businesses whose fortunes are tied directly to the ups and downs of the wider economy. Think of airlines, car manufacturers, construction companies, and most banks. When the economy is booming, people buy cars and fly on vacation, and these companies make a lot of money. But when a recession hits, their profits can evaporate or turn into massive losses overnight. Their performance is unpredictable. Smith prefers the all-weather business that sells things people need or desire, regardless of the economic climate. He wants the swimmer who can perform in any water, not the surfer who needs a big wave to look good. He also avoids companies that require massive, ongoing capital investment just to stay in business. Think of heavy industries like steel manufacturing or utilities. These companies have to spend billions of dollars constantly on maintaining and upgrading their plants and equipment. This soaks up all their cash, leaving very little free cash flow for shareholders. It's like owning a classic car that's beautiful but requires constant, expensive repairs just to keep it on the road. And as we mentioned earlier, he has an almost allergic reaction to high leverage or debt. This is another reason he avoids banks. Banks, by their very nature, are highly leveraged. They borrow huge amounts of money to then lend out. This makes them inherently fragile, and their balance sheets incredibly complex and opaque. Smith jokes that there are two types of people who have a view on bank shares: those who don't understand them, and those who do, and those who know they don't understand them. He puts himself firmly in the second camp. Let's look at some real companies to make this more concrete. A typical Terry Smith portfolio might include names like Microsoft, L'Oreal, Novo Nordisk, Philip Morris, and Stryker. Let's see why. Microsoft has a dominant position in software with recurring subscription revenue from Office 365 and its Azure cloud platform. It has enormous pricing power and generates mountains of cash. L'Oreal owns a portfolio of incredible cosmetic and skincare brands that people buy repeatedly all over the world. Novo Nordisk has a dominant, patent-protected position in diabetes and weight loss drugs. Philip Morris sells an addictive product with incredible brand loyalty and pricing power. And Stryker makes medical devices like artificial hips and knees, which hospitals buy consistently and are very sticky products, as surgeons are reluctant to switch once they are trained on a particular system. Notice what these businesses have in common. They are global leaders. They sell products that people buy over and over again. They are protected by powerful moats, and they are not heavily dependent on the economic cycle. They are the kinds of businesses you can buy and, with a bit of monitoring, potentially hold for a very long time. Of course, no strategy is perfect, and it's important to understand the potential downsides or critiques of this approach. One issue is that quality stocks can become extremely popular and therefore very expensive. For a few years, everyone wanted to own these types of predictable, growing businesses, which push their valuations to eye-watering levels. At times like that, the don't overpay rule becomes extremely hard to follow. Another point is concentration. Smith typically holds only 20 to 30 stocks in his fund. This is very different from an index fund that might hold 500 or more. This concentration means that if he gets a few calls right, the performance can be spectacular. But it also means that if one of his major holdings gets into serious trouble, it will have a much bigger negative impact on the overall portfolio. It's a higher conviction and therefore higher risk approach than simple diversification. The strategy can also underperform for periods of time. In a market environment where low-quality, economically sensitive, junk stocks are rallying hard, a portfolio of steady, high-quality companies can look boring and lag behind. This is where the psychological challenge of doing nothing comes in. It requires the patience to stick with your strategy, even when it's temporarily out of fashion. In essence, Terry Smith's approach is a vote for business quality and long-term discipline over short-term speculation and market timing. He is not trying to be clever. He's not trying to predict the next interest rate move or the winner of the next election. He's trying to do something much simpler, yet much more powerful: to become a part owner of a small number of the very best businesses in the world. The real work in this strategy is not the frantic daily trading. It's the intense, upfront research to identify those genuinely superior companies. It's the patient discipline to wait for a fair price. And it's the emotional fortitude to hold on through thick and thin, letting the magnificent power of compounding do its work over decades. It's a philosophy that is simple to understand, but requires immense patience and discipline to execute properly, which is why so few actually succeed at it.